Okay, so how does a CRNA loan treat your student loans? You may have heard me say that a CRNA loan, similar to a physician loan or a doctor mortgage, is more accommodating or has more liberal underwriting guidelines. But how does that relate specifically to your student loans? Because most of the CRNA that I know have a few student loans still. All right, so here's how it works. In the conventional world of mortgage underwriting, which is pretty much every bank in the country, because conventional loans are typically purchased or saleable to Fannie Mae and Freddie Mac. Fannie Mae and Freddie Mac are the government-sponsored enterprises that make about 90% of the loans, actually between Fannie, Freddie, and Jenny, who does FHA loans. They do about over 90% of the residential mortgage lending in the country. So pretty much they write all the rules. Everything has to flow up to their guidelines. And so conventional underwriting guidelines, regardless of the bank that you end up going with, will typically want to count a 1% of the outstanding student loans against your debt to income ratio if your student loans are in deferral or in some sort of income-driven repayment. Now, many of the, especially younger CRNA that we work with, are either still in deferral or have some sort of an income-driven repayment until they kind of ramp up and get stabilized. And qualifying at a 1% of that outstanding student loan balance can be prohibitive to them qualifying. For example, if someone had $300,000 in student loans and was just getting going, and they had to qualify as a $3,000 a month payment, they very well may not qualify for the home that they want. They may have to settle for a much lower home. So here's how we look at it with a CRNA loan. If the loan is currently in a deferral, has a zero payment, we can simply get an estimate from your student loan provider, whoever the servicer is on your student loans, as to what the estimated income-driven repayment would be. If you go into pay as you earn or repay, we simply just get a letter from them saying, here's the loans that you have, here's what your payment would be if you went into one of these income-driven repayments, and that's the loan amount that we qualify you on. Now the beauty with that is that's typically done at the previous year's tax return, so you're almost always going to have a lower income-driven payment qualifying amount than you would if you defaulted to the 1% rule. Hey, I hope this was helpful. We'd be honored to help you into your new house, and we'd be more than happy to answer any questions you might have. So please don't hesitate to either call or email us. We're looking forward to hearing from you.